All right, welcome everybody. Anmol here again. So today I have a very interesting guest, David Lin. He's had me on his shows a bunch of times on Kitco News, and now he's branched out, started the David Lin Report, which has obviously seen a lot of great traction on YouTube. The channel is growing fast, and I wanted to chat with him because it brings a different perspective. I'm tired of chatting to people who are just giving their market analysis or just talking up their book, but it's also very interesting to learn from people who can bring a different insight into the markets and what they've gathered after interviewing a lot of people. David obviously has been involved with Kitco News and now with David Lin Report. He interviews different guests on different walks of life from the markets. And today I want to chat with him about his journey on how he got started. But before I continue, David, give a little bit introduction on how you got even started in this industry of making videos, interviewing guests, and how did you get into it?
Hey, Anmol, thanks for having me. Great honor to be invited on your show. I've interviewed you a bunch of times over the last couple of couple of years. Really, we've known each other. You're popular not just amongst my audience, but the people I used to work with at my last job. The videographer, the guy who has nothing to do with finance, he was like, "Yo, when are you inviting Anmol back?" Because he does some trading on Robinhood and stuff. He was just like, "I want to know what stocks to buy and sell." So he was just like, "Hey, bring Anmol back on." So anyway, pleasure to speak with you in any capacity. My journey was I wanted to be a trader like you, and I failed. So now I'm asking people questions about trading. That's basically it. I did finance at McGill. I graduated from finance, did my BCom there in Canada, so Montreal. And I initially wanted to do I wanted to do finance. So I ended up working in macroeconomics research for about 4.5, 5 years. During that time, I was on Quest Trade and a bunch of different things, just playing the stock markets. I remember I back then I was like 23. I had no money, so I wanted to trade, and I didn't have any cash on me. So because I just started my job, so I went to the bank. I asked them, "Can I get a line of credit?" And they said, "What for?" I said, "I want to trade stocks." She looked at me like, okay, you want to get debt to trade stocks." Basically things that you told me on my show that you should not do. I've made
Right.
those mistakes when I was 23. And so I borrowed like a couple $1,000s. And then she was like, "Do you have like stocks in mind?" I think she was looking for tips at that point. And I just said to her, like, "No, I really don't. I'm just gonna like figure it out." So I ended up like losing all of it, mostly through options trading, which I knew. I read one book on covered call options, and I thought I was like Grandmaster David Lin on options trading. I was not. So learned that the hard way. Anyway, I did finance for 5 years. I ended up working at Kitco News as a producer for 2 years, anchored for them for 3 years, and I decided this year, well, last year I was thinking about it, but this year I resigned and I started my own channel. I wanted to be an entrepreneur. I wanted to start my own business, and I wanted to really pave the way for a new era of what I believe is decentralized media. And I wanted to be at the forefront of that. So that's where I am right now. I focus on finance and economics and more tech now. So I've just reached 106,000 subscribers in the course of 5 months. I started in May. So sorry, I started in March this year, 2023. So within five months, I reached 100,000 subs, and it's growing. And thanks to great guests like yourself.
Oh, that's awesome, man. And what's good to hear is like people who are interested in the stock market don't have to always be a trader. I tell people all the time, like if that's your passion, if that's your curiosity, it doesn't necessarily mean you're going to be a day trader or you're going to be a swing trader. There's a lot of different ways you can dip your feet in the market. And it looks like obviously you found a great footing by, using your macroeconomics and learning all of that, using your curiosity and passion and still being involved in the markets pretty much every day. You're more in tune with a lot of people that I've met. A lot of people who do this for a living are properly still not in tune with the market. So it's great to see that you found your passion, and obviously your channel has done amazing. I
Thank you.
mean, we've been doing it since 2015, and I think that YouTube didn't even know our channel existed till like 2018, and then finally, started to get some traction out of that. So 5 months, 6 months that you've grown, it's obviously fantastic. So, and also, you're a great violin player, by the way. If nobody knows about that. He's got a hidden talent, man of many talents as
I,
well.
I did not
So,
pay Ammo to say that. He just stalked my online profile and he
I'll,
found it.
I'll,
But yeah, it's a passion project. Funny story. You asked me about my background. I didn't give you. So before I went to college, I wanted to be a professional musician. That was my passion. My dream was to become like a solo musician. I played violin and piano, and my mom was like, "No, go to business school instead." So that's what happened. But yeah, I still play music for fun. I don't have any
Nice.
regrets. Yeah.
No, that's awesome, man. Because I think it's good to have a passion like that, like have a little downtime. And I think that's one of the things that I didn't really like about the finance industry when I was trying to open up my hedge fund. Just the people I met, I'm like, you don't look happy. You don't look like you do anything outside with the markets, And I was like, do I really want that? Do I? And then I got into golf. I started doing a lot of other things. I travel a lot, go hiking a lot. Like this weekend, going to Catskill Mountains, to little cabin, little downtime. And that was one of the things. Now, you've obviously chatted with a lot of different people throughout your career who have hedge funds. Like, what is your sense of that business? When you think about hedge funds, what's the first thing that comes to your mind?
Uh, broken dreams. That's what I wanted to do. Now I'm talking to hedge fund managers. That you asked me my first thing that came to my mind. That's the first thing that came to my mind. Hedge fund managers, they're an interesting bunch. A lot of them do super well for themselves. If you look at the statistics, the majority don't beat the markets, and that's something that I've tried to ask through my interviews is what the strategy is to beat the markets. People have very interesting various strategies that very diverse industry. Hedge fund is not just one size fits all. I've talked to a lot of different fund managers, all with different strategies, different books. So it's very fascinating talking to fund managers.
Nice. Now, in terms of like the market pulse, like obviously you've interviewed just over the last month, you've interviewed so many different guests. What's your feel on the markets right now? Where are we? Are we in a recession? I mean, the data says it's coming, but a lot of people, including me, think it's already here. Where do you see the markets headed? I mean, not like a prediction, but based on everything you've chatted and gathered from different people, what's your pulse on the market right now?
Yeah.
What's the consensus like?
Several of the hedge fund managers I talked to, going back to your last question, are quite bullish still. They've done quite well in the year by being bullish, and they're continuing their bullish stance. My personal stance is that based on the data, I don't believe we are yet in a recession. If you look at, I think there's a common misconception that a recession in the U.S. is 2 quarters of negative real GDP growth. That's actually, I mean, that's a textbook definition. Some other countries follow that. But if you look at, let's say, the NBER, the National Bureau of Economic Research, which is the organization that designates recessions and kind of provides a goalpost of when we are in a recession. They always look back after the fact, like, we've been in a recession during this time, but they haven't officially designated this area as a recession yet. They haven't announced last year as a recession. And remember, last year we had 2 quarters of negative real GDP growth. They look at 7 indicators. It's on their website. In fact, they have a website link called FAQs, and in their FAQs, they have a section that's called "Do we need 2 quarters of real GDP growth to be negative to have a recession?" And the answer is no. They look at 7 different indicators, including the labor market, industrial production, retail sales, and a lot of other things. So 7 different things. And I think I was talking to some economists about this. So far, 4 of these indicators are flashing negative. If you look at leading indicators, so for example, the leading economic indicator, that's going down, which is a good indicator of things slowing down. The labor market so far is still strong. I think growth in the labor market has been slowing down, but that could just be an indicator that the labor market is already well absorbed, in the sense that unemployment is relatively low. So it's not growing because most people already have jobs. So that's not necessarily a bad sign. Advanced retail sales, if you look at the St. Louis Fed data, that's still nearing all-time highs in nominal terms. And 2 years ago, you could have attributed that to inflation because things got more expensive. And although inflation has come down, prices are still elevated, but it's come down. So you can't really attribute nominal retail sales peaking to just higher prices. I think people are spending. There's an interesting chart that you can draw your readers' attention to. It's from the Federal Reserve. If you just Google Federal Reserve wealth by wealth percentile group, so it breaks down how much wealth each quartile or distribution of wealth people have. And so the bottom 50% of wealthy people in America, so the least wealthy people, their net worth has not moved in the last, I would say, 6 months or so. If you start moving up to the top 10%, top 1%, which actually holds the most wealth in this distribution, their net worth has been steadily increasing and has been correlated with the markets. So wealthy people are feeling more wealthy because real estate is going up. Despite mortgage rates going up, wealthy people are feeling wealthy because they've invested maybe in the markets, and the markets have done well this year. And so they're still driving a lot of the retail sales and the demand. Now, one could argue that consumer demand could slow down. I think the general sentiment from the people that I've talked to is that there is going to be a recession. There is going to be a slowdown. It's just not happening right away. It's going to happen next year. That does seem to be the consensus on Wall Street. I think you and I talked about this. Citi's chief economist has predicted that next year will be a recession. The Bank of America, same thing. Last year, they predicted a recession would come this year. Now they're saying next year. I've had people on my own show who call for a recession by this summer, pushing it back to next year. And the general sentiment is that the Fed will keep their rates for longer, higher for longer, which would cause a slowdown in aggregate demand eventually. There's always a lag effect. So even though things are doing well now, it'll eventually slow down at some point once the lag effects kick in. So to answer your question, short, I don't believe that the U.S. economy, at least, is currently in a technical recession. I think things are starting to slow down. And based on the guests that I've interviewed and what I've read on mainstream media, economists tend to believe that a recession will come by Q1, if not Q2 next year. And it does seem to me that traders are pricing that in as well. If you look at the CME Fed Watch tool, we're getting a higher probability of a rate cut by next year. The Fed usually cuts into a recession, so that makes sense.
Right. Yeah. And I'm kind of with you on that. I think this year is just considered, we came back, we might just chop around technically. And I think next year is going to be a lot of uncertainty because, despite of which political aisle of spectrum people are on, the thing is that I just don't see it going well, regardless of, who gets elected in the U.S. in 2024. So I do think even next year, we might not get that big market pullback, I guess, that people are expecting, but probably as the election results come towards the end of next year, I think that's where there's going to be a lot of uncertainty, and we'll see what goes on in the United States. But a lot of people also say the prices are higher, not because of the fault of the Federal Reserve of the U.S., but because just oil's expensive because the Saudi, people are raising all the oil prices and the supply. And then some people are saying the food prices are higher because of what's going on in Russia. So the inflation is being caused by that. What's your view on that? Is inflation the result of federal monetary policy or what's going on in the economy, or is it caused by external geopolitical circumstance with what's going on with Russia and what the OPEC and other countries are doing with oil?
I think it's a combination of monetary policy and supply shocks caused by the lockdowns during the pandemic. Now, there's various schools of thoughts. The hardcore monetarists, the people like Steve Hanke, who I've interviewed many times on my own show. He's an economist, professor of applied economics at Johns Hopkins University. He follows the Friedman school of thought, which is that inflation is caused by an increase in the money supply. And this is not a view that the Federal Reserve Chair Jerome Powell believes. In fact, in 2022, I think in 2021 or 2022, he said that we need to unlearn monetarism, which is something that is something that Steve Hanke does not agree with. But anyway, monetarists believe that the increase in the money supply leads to inflation. Now, if you take a chart of the M2 money supply growth on an annual percent change basis, and if you plot that next to the CPI on an annual percent change basis, which is the inflation rate, there is a nearly perfect correlation. I'm not saying one causes the other. I'm just saying there's a correlation there. Correlation, as you know, does not necessarily equate to causation, but it is very much correlated going back into the last 70 years of data. I believe also that supply chain issues have greatly exacerbated any effects that the monetary supply increase have caused on prices. And if you look at what the Ukraine war has done, it's probably impacted food from that region. So I think the closer you are to Ukraine, the more impacted you are. They're a big exporter of grains, wheats, other soft commodities, and agricultural products. But in North America, we have production of those things already. The food price index, if the FAO food price index from the United Nations has been trending down over the last year, despite the Ukraine war happening. If you go on the UN website, if you look at the food price index, it spiked shortly after the pandemic, and then it kept just coming down despite the Ukraine war continuing. So I think it had a limited effect on inflation in the West. I believe mostly it was due to the Federal Reserve increasing its monetary base, and also just supply shocks, bottlenecks in supply, and things not getting here the way they should have. I mean, just think about your own life, going out to restaurants, hearing even in Canada. Canada was not directly affected by the Federal Reserve. Of course, the central bank here had stimulus. Of course, the fiscal policies of the Canadian government had introduced stimulus during the pandemic. But if I remember during the pandemic, I went to a restaurant, and everywhere prices rose by at least 25%. In fact, on the menus, they said, because of supply chain issues, we had to raise prices. It's not a direct result of, let's say, the money supply growing. These restaurant owners just couldn't get the fish that they wanted from Japan. If you wanted sushi, for example, that was a big issue. Those issues have more or less sorted themselves out, and that's why you see the inflation rate come down. Not the prices come down, although we've talked about Tesla dropping their prices. Some things have come down. A good exercise for your listeners right now is to just go online, go to the BLS website, and go look up the CPI breakdown. Every month they publish a CPI report. If you click on the PDF, there's a big breakdown of all the components of the CPI. You can see which things have been going up, which things have been coming down. So for the last 2 months, grocery items have still gone up. Food items have still gone up. Food away from home, so restaurant has still gone up. Things that have gone down, things like within the food basket, things like bacon, things like chicken, just very, very specific things that are impacted by industry specific events. Things like airline fares have gone down. So inflation overall has gone up, but there are certain things that are starting to deflate. So to answer your question, I think it's a combination of monetary supply and a money supply, and also supply chain issues.
Yeah, it's a tough job, isn't it? As like a Federal Reserve chairman, I was telling people, like, everybody hates on Federal, chairperson, whoever, Jerome Powell, whoever it might be. I'm always like, it's the toughest job. Nobody will ever like you. If you raise rates, half the people are going to hate you. If you lower rates, half the people are going to hate you. No matter what you do, you're going to be hated. And that's probably one of the jobs that I wouldn't want to take. But, talking about what you touched upon earlier, like how the rich aren't really feeling it, right? People with a high net worth, the top 1%, they're still holding on to their wealth. And then maybe the rest of the people are feeling that pain of the inflation. And you can see that no better than even car prices, right? New car prices have actually sort of stabilized or sort of come down, including Tesla. But if you look at luxury assets or luxury cars, they've actually gone up in price. I mean, recently I sold my car and I got 30,000 more than what I paid for it. So basically I drove it free for 2-3 years. And when I get out of the car, I got 30,000 more than what I bought it for. And I was like, wow, this is great. So I think that's one of the things that we're noticing. Luxury assets haven't dropped. I follow the watch market a lot, like as an asset class, luxury assets. And those have, in fact, gone up in value. Rolexes have gone up.
I thought Rolexes came down.
No, a lot of the secondary market, the good pieces, the Daytona, the well-known pieces like the Daytona with a white face, all of those have actually stabilized, and in fact, they've steadily just been climbing. Whereas the other assets, the maybe less than $20,000 watches, they've come down a little bit, but anything over 20,000 has basically just stayed the same, if not gone up. And that's one of the things. I'm actually curious:
are authorized dealers now stocking their inventory for Rolex?
I don't know about that. Like, I do a lot of the secondary market, so it's a lot of different wholesalers, suppliers. So we're doing a lot of trading in that department as well. And they've never come down because a lot of the pieces that I sold, for much higher than where I bought it from, I can't buy it back anymore because they just stayed the same. So that's one of the things that I'm noticing, that the average consumer for their goods, the meat, the products they want to buy, they've continued to go up. But for luxury assets, they've maintained their value. They haven't really done anything in that department.
I think going back to your first question as to whether or not I believe we're in a recession, I think the biggest indicator of any recession is it has to be a spike in unemployment. People have to have been laid off or are transitioning to other jobs, and that's just not happening right now. The labor market is still relatively tight. So until that happens, I don't think we can definitively say we are in a recession. I think some sectors are weaker than others. I think some people are feeling the pain of inflation more than others, but overall the economy we need to see unemployment go up first.
Right. And talk to me about like that job number, because I see I'm not a fundamental guy. I've been, charts are my thing. So in that data where they calculate the unemployment numbers and the job creation, how are people who work from home or people who are creators, right? How is that accounted for in the data?
Well, to be counted as unemployed, you have to file
File
for
for
like
unemployment.
unemployment insurance. You have to be actively looking for a job, and you have to be currently not employed. So that those two things have to be there in order for you to count to be as unemployed. So if you're working from home and you're paying your taxes, you're not unemployed. Also, if you're not looking for a job, you're also not counted in the unemployment rate. You're just not in the labor force. So the unemployment rate is people within the labor force that is currently looking for a job. If you're not in either of those categories, you're not in the labor force, then you're not part of even the labor force participation rate. You're just not part of the labor force. And let me just look up what the labor force participation rate is. I don't think it's changed dramatically over the last year. I think over the last 20 years, it's been steadily coming down. It had a huge drop during the pandemic for obvious reasons, and then it started to climb back up. The labor force participation rate is still not quite at pre-pandemic levels. So that shows to me that there's a lot of people that used to be employed that are no longer in the labor force. I can't really ascribe a reason as to why that is. We'll have to look deeper into who exactly is not currently in the labor force, but it's potentially people who have made a lot of money during during the COVID market rush, who are maybe just retired. So yeah, it's
Right.
interesting. The labor market is not weak by any measure, but it's not maybe as strong as it used to be pre-COVID. The unemployment rate is still near all-time lows.
Makes sense. Now, moving gears a little bit, what's happening with the U.S. dollar? I mean, it just keeps going up. We're looking at the ETF UUP, and we know that the dollar has an inverse relationship with commodities and even stock market to a certain extent, right? As the dollar gets more expensive, foreign investors feel like pulling out their money. As the dollar gets cheaper, more money comes in. And recently, we've just seen, I think, 6 or 7 weeks of the UUP ETF, the dollar index, just continually go up 6, 7 weeks in a row. And that's caused downward pressure on things like silver, gold, and even markets started to pull back a little bit. Where do you see the dollar going, or where based on the chats that you might have had, has there any been discussions on the consensus on the US dollar and what that means for commodities going forward? Because, I'm a buyer of silver, I'm an owner of silver, but I'm definitely not happy because every time it gets a little momentum, the dollar starts shooting up, silver comes right back down. And last week
Yeah.
was one of those weeks where silver just, gave up all of its gain that it had. So what's the consensus after speaking to a lot of different people on silver, gold, and the US dollar?
Well, let's start with the U.S. dollar. So yeah, the U.S. dollar has been seeing strength over the last 2 months. A lot of it has to do with the 10-year yield rising to 17-year highs, and that's for a variety of reasons. People are been selling bonds because they've been buying stocks, or even the inverse. But markets are feeling a little more bullish, so they've been selling off treasuries, pushing down the price, pushing up the yield, pushing up the dollar. The Federal Reserve has continued to raise rates, or has continued to indicate hawkishness, even despite other central banks pausing. The Bank of Canada recently paused. The People's Bank of China cut rates. So all around the world, we're seeing other central banks slightly less hawkish than the Fed. And of course, we know that the DXY is a dollar versus a basket of other currencies. If you have interest rate, currencies are based on interest rate differentials. So if you have the interest rate in the U.S. going up and other interest rates coming down in the other countries, then the U.S. dollar is going to see continued strength. And so as long as we have policy divergence between the central bank in the U.S. and other central banks around the world, we're going to continue to see U.S. dollar strength in the short term, is the consensus that I've heard. Gold and silver, I haven't, on my own show, I haven't heard people calling for $3,000 gold anytime soon. I think people are
That happened on Kitco a lot of times as well,
yeah, that
like five
happened.
thousand
Yeah,
dollars,
that happened
ten
on a gold
thousand.
bug. I think people realize I'm not a gold bug channel anymore, so they stopped giving me those calls. But anyway, I've been hearing 2,200, 2,400 as new highs, and really gold has had a quite remarkable year when you look at it, considering that interest rates have gone up, considering the Fed has tightened monetary policy, considering the dollar has has been stable all year round and has actually recently moved up, considering that stocks are doing well. If you think about all the variables that run counter to gold, they've all gone up, yet gold is still hovering around, what, 1950, 1960, something like that. It's breached new all-time highs briefly this year. I think gold will continue to trade within this range for the next couple of months. And really, you're looking at what drives the price of gold. So gold is inversely related to the US dollar. Gold is inversely related to real interest rates. Gold historically has had a very weak correlation, if no correlation at all, to actual inflation. So if you run the CPI annual percent change versus the gold price annual percent change, there's no correlation there. So gold isn't directly hedge against inflation in the short term. And actually, as a matter of fact, all throughout last year, while inflation was rising, gold was coming down. And all throughout this year, when inflation was coming down, gold was going up. So there's very little impact on the price of gold from inflation. There is a very close or very strong impact from the DXY, as well as the real interest rate, which is the nominal rate minus the inflation rate. So you have to then break down those two variables. Where do you see bond yields headed, and where do you see the inflation rate headed? The consensus from pretty much not everyone, but most of my guests think that inflation will come down a little bit and stabilize somewhat before eventually hitting the Fed's 2% target down the line. Not immediately, but very few people have been calling for higher inflation. There have been some economists calling for another wave of inflation to hit maybe next year as consumer demand continues to remain strong and perhaps energy prices push up inflation. But they're not calling for inflation to spike up to 9% again, which is what we saw in 2021. The nominal yields, as long as the Federal Reserve continues its hawkish stance relative to the other central banks, we're going to see yields continue to go up, which means that real interest rates are going to continue to either stay elevated or go up, which would put further pressure on gold. So I don't see gold breaking out to new all-time highs and staying there for the next few months until we get weakness in the real interest rate. It's going to provide a real headwind on the price of gold. And like I said earlier, the US dollar is going to see maybe short-term strength is the consensus from my guess. So that is also going to put pressure on gold. But at current prices, I mean, gold is not bad, considering that in some currencies, it's already near all-time highs or above all-time highs, and it's already breached all-time highs this year. So if you bought gold last year, you're doing well.
Right, totally. And is it the same outlook you have on silver as well?
Silver tends to follow gold, obviously, with more of an industrial component. So if you believe a recession is coming or near, we may see a slowdown in some industrial production that may use silver. But if you look at what uses silver the most nowadays, it used to be like things like film and cameras, but Kodak is dead, so we don't use film anymore. But silver is used a lot in solar panels, is used a lot in the electrification of things. It's used in electronics. It's used in cars, some batteries as well, although it's not an essential battery metal. But it has a lot of industrial uses. So if you assume that there's going to be a huge slowdown in industrial production, then you might see some pressure on silver and silver-related products. I'm not an expert on the other areas of silver, which is the use cases of silver. From a jewelry perspective or refining perspective, I think you have to speak to actual silver experts on that. But generally, you have to keep in mind that silver has two components: a monetary component, which closely follows gold with a higher beta, and an industrial component. For the last year and a half, for the last two years of data that I've observed, silver has followed gold very closely. So if you believe that gold will continue to be under pressure or will just trade within a range, I don't see silver doing anything different.
All right. And talking about like a hedge to inflation, are you still hearing the arguments that we used to hear last year? Bitcoin's a hedge to inflation. Do people still talk about that? Haven't heard that in a while.
Yeah. No, I have not. No, Bitcoin is down. Obviously, as you know, it's up since last November. It's up 80% since the lows, but it's still down like what is it now? $27,000. Yeah, it's down more than 50% from its highs. So we're still in the long-term bear market is the consensus that I've actually, and I've asked this to my guests, like, are we in a bull market or a bear market? Because we're up 80% from the lows, but we're down like 60% from the highs. Well, we're still in a long-term bear market. Bitcoin is not a short-term inflation hedge. People have argued it's a long-term inflation hedge because over its 13-year history. It's beat every single asset. Well, by that argument, so is Tesla stock. So is
Yeah.
Amazon. So I don't really buy that argument myself. Just because something's outperforming doesn't necessarily mean it's an inflation
Right.
hedge over the long term. I think something is an inflation hedge if it actually follows the CPI more closely and actually outperforms the CPI on a regular basis. And that's just not what the characteristic of Bitcoin is.
Yeah, totally. Finally, a good argument, because a lot of people used to say that, and I used to say the same thing, and I'm like, really? So that way, any stock, AI is a hedge to inflation, or anything is a hedge to inflation.
Yeah.
And I do see that it has calmed down. A lot of people with crazy price targets back in the day for Bitcoin, and we're not hearing a lot of those arguments right now. But are people, in your opinion, after chatting with people, are they still bullish on Bitcoin overall, long term, or is that maybe one of those things they say, okay, maybe dead for next couple of years, but eventually it's still a good thing?
It's a mix. I think the Bitcoiners, the people who believe in Bitcoin, they're still long-term bullish. And I think most people I've talked to believe that there's long-term potential for Bitcoin. I think the exception would be like people like Peter Schiff, who really likes gold and hates Bitcoin. Bitcoin's intrinsic value is zero. I've heard that before. Steve Hanke doesn't like Bitcoin. But anyway, I think the people who do believe in the technology and believe in blockchain overall see long-term potential in Bitcoin. It comes in cycles. If you just look at the historic price pattern, will there be another bull market? I do believe so. I think, if you believe that cycles recur, which have been pretty consistent in Bitcoin's history, then we should see another bull market when stocks are ready to rally again. It's interesting how people are saying Bitcoin, is in the bear market. Yeah, that's true, but so have stocks. If you take a look at stocks, they're so down from their all-time highs from last year, as you know, but they've rallied considerably. The large caps have rallied considerably this year, just like Bitcoin's rallied 80% this year. So there are cycles. There are people that believe that, like Gary Soloway believes that there's still short-term weakness in Bitcoin. I think some other technical traders believe there's short-term weakness, but the long-term potential of Bitcoin, most people say, will propel the price to reach new all-time highs. And actually, it's not just people on my own show. If you take a look at some Wall Street firms, Standard Chartered, a couple months ago, put out a $100,000 Bitcoin price target by 2024. So they're not saying this year, but by next year. People are also telling me that the halving, which will come next year, will boost prices because historically the halving cycle is usually followed by higher prices within 6 months. Yes, that is true. That's happened in every single cycle. But two things to keep in mind. Just because something's happened in the past doesn't necessarily mean it's going to happen in the future. If you talk to computer scientists, they will agree, yes, the halving will make the computation more difficult to mine Bitcoin. So fundamentally, you should see it. It'll be more difficult to mine Bitcoin, so it makes sense to have a higher price because the miners need a higher price to stay elevated or to stay operational.
Right. Yeah,
However,
I've
you
heard
have
you
to
think
consider.
about too.
Yeah,
Go
you have
ahead.
to consider that next year. If you believe there's going to be a recession, there's never been a Bitcoin halving cycle during a recession. So if Bitcoin follows stocks and stocks are going to go down to a recession, I don't know how much the halving cycle is going to save Bitcoin from falling with stocks. So you got to be careful there.
Right. Yeah, that's one of the comments I made recently. I was saying people are really looking forward to two things, right? The Bitcoin ETF approvals coming in, maybe bring in some more cash, into the ecosystem there, and talking about the Bitcoin halving. But I was like, my gut feel is that Bitcoin halving, only thing that's going to be halved is your account. Like when it drops another 50%. Because for me, I think price predictions are one of those things where if you're an investor, it doesn't really matter, right? Everything has cycles, bull and bear markets. Tesla's dropped as well before it came back up again. So I think a lot of things are price movements always happen. It's just about, I guess, your thesis and belief in what you really believe in as fundamentally.
Yeah.
Like I'm not a believer. I'm a believer in blockchain. I'm a believer in the technology. Just like the early stages of internet, right? You have AOL comes out. That's the first one. That's the Bitcoin, in my opinion, of the crypto industry, the AOL. But then better, faster technology comes place, and then eventually is now there's no more MySpace, there's no more anything, is Facebook and the newer technology. I think that's kind of where I see headed. But again, time will tell. I do agree with you though. I do think there's one more bull market left, which I like to call famously on our live streams is that's the final bull market you're gonna see. Just like institutions can get out, and then we'll see where things go from there. Are there any other projects you've been following in the crypto space or people talking about a lot except for Bitcoin?
Well, earlier in the year, Bitcoin ordinals have pushed up the transaction costs of Bitcoin. That's come down. But that was a pretty interesting breakthrough. How the layer one of Bitcoin now has utility beyond what it used to have. So people are transcribing information onto the Bitcoin layer one, kind of like a safe blockchain database. If you believe that you're gonna, I guess, lose your USB or whatever, then I guess that's one way to save your data. Other projects I'm following, not currently at the moment, no. It's interesting how I think it'll be interesting to follow the ETH futures ETFs that people are building now. ARK is on. The Bitcoin ETF is the most talked about ETF in history. I don't know if it's going to have any further impact on the price beyond what's already priced in. Any news seems to, I think it'll have short-term impact. We saw a couple weeks ago short-term announcement on Grayscale beating the SEC in the lawsuit. That pushed up the price briefly, and then when the next day when the SEC announced they would hold off on approving applications, Bitcoin ETF applications until October, the price came back down. So it's very much news dependent. I think it will have a short-term impact on the price, but long-term, think about it fundamentally, right? Institutions buying Bitcoin, can they already do that? Well, if they can't buy spot Bitcoin, they can use other avenues. They can buy Bitcoin proxies. They can buy Bitcoin miners. They can buy MicroStrategy stock, which has basically a Bitcoin proxy at this point. They can buy Bitcoin futures if you're a trader. There's already a lot of ways for institutions to buy Bitcoin. My argument is, why would a Bitcoin ETF fundamentally change institutional demand? It might make it easier for some funds. I'm not denying that, but I don't think it'll make a huge impact because there's already other avenues people can take if you're on the institutional side. If you're on the retail side, why would you pay a management fee to buy spot Bitcoin? Why don't you just buy spot Bitcoin? And what people say, well, it's easier. I don't have to open a wallet. I can just buy it through my Roth account or whatever, trade with my ETF account. Sure, yeah, I mean, it'll make it easier, but it's not going to fundamentally change the demand landscape for Bitcoin. I think it'll make it easier for some people that haven't had access to Bitcoin yet, but it's not like you've got like billions of people just waiting for the Bitcoin ETF because they couldn't buy Bitcoin already. There's other ways to buy Bitcoin.
That's a great argument. That's a great argument because I think people always get tied up in that. Oh, capital's coming in, but I tend to agree. I think people who want to buy it can buy it anyway. I mean, most funds do have it. Like I met the other day Anthony Scaramucci at his office, and he holds a lot of Bitcoin, right, in his fund. So it doesn't need an ETF to come out to buy Bitcoin. In fact, I think the ETF makes it easier to be shorted, right? It makes options.
That's a good point.
Those, it makes it easier to be shorted. So maybe, again, I'm not a conspiracy theorist, but it could be one of those strategies as a hedge, so they can hedge their actual crypto positions rather than influx of new capital. So totally tend to agree with that.
Might make might make it even more centralized because you got basically more whales are able to hold larger percentage. But yeah.
Right, totally. But that's the decentralization revolution, like it's actually getting more and more centralized. And I think that's one of the things that I'm seeing is that people in Bitcoin have really good intentions. Like I tend to agree with where the revolution and all that stuff they're going with, but I think they tend to forget that in pursuit of that, it's actually just making things more centralized. Where's the actual decentralization when you're going to have ETFs, when you're going to have all those things, when you're going to have banks control what you cannot buy. Right. So that's definitely one of those things to take care of. But David, obviously, great chat. Tell me a little bit more about what's next for you. What's next for David Lin Report? What's next for your channel? What are you looking to go for? And just tell people where they can find you.
Oh, well, thank you for the introduction. You can find me on my channels on YouTube at the David Lin Report. You can look it up. I just interviewed Anmol this week, so you can find Anmol's interview with me there as well. I'm just going to keep doing the same thing that I'm doing, grow it, expand it, get more guests, get production volume even higher. I'm pumping out one video a day. I want to eventually get it up to 2 a day and then 3. So I am going to expand my team. My focus, my mission is to build one of the most respected and influential finance channels on the internet. And eventually I may also bring on other reporters and anchors as well. So I'm not the only face of it. I may need to rebrand at that point, but I want to become the go-to shop for anybody who wants to learn about finance and economics and trading and even technology. And my mission is to build a media company that all generations can relate to, and doesn't matter what you do in life. Everybody needs to understand the economy because the economy affects everybody. So I want to build a channel that will educate everybody about the world around them, not just for traders and investors. So for now, short term, I'm going to do the same thing I'm doing now, continue pumping out videos, expand. Long term, further expansion into other areas, into other sectors, and enlarge my team and just make this as influential as possible.
That's awesome, man. I definitely agree that we need like an alternative to the traditional media when it comes to finance, because when you bring on different guests, when you chat with a lot of different people, when you have your own insights, people actually get to learn and they can make up their own mind. It's not like, okay, this is how it is. They can make up their own mind. Whereas traditional media, they don't let you make up their own mind. They're like, this is how it is, or it's buy, or sell, sell, sell. It's price predictions all the way through, rather than saying, okay, here's where I'm at, here's where you're at. Let's make up your mind. Everybody will have a different thesis. So I think definitely a need in the market for that. And glad to see your continued success and your growth on your channel. And yeah, always great chatting with you.
I appreciate it. Actually, before we go, I have a question for you, because I think we both like cars. If you had to buy one car and you could go anywhere in the world with it, what would it be?
Well, as a Tesla shareholder, I'm going to say no. I'm just kidding. I was going to say Model X,
Cybertruck.
Yes, I mean, honestly, the Roadster when it comes out. Like if that actually comes out, which we don't know when it's going to come out, but Tesla Roadster, heartbeat. Like I'm not going to even think about it. I'm definitely buying that car.
You're going to daily drive a Roadster?
I really drove a Ferrari for the last 3 years, so I mean, Roadster is not a bad thing. But New York, you don't really get a chance to drive anyway. I mean, you're Ubering all the way through unless you're leaving the city, like I'm heading tomorrow. But yeah, I mean, Roadster is what I would say. Apart from that, I do like the Urus, or if that's how you pronounce it, the Lamborghini.
Yeah.
That SUV, when I was in Dubai, I rented it for like a week and I had a blast. So I think that car I really love driving. So yeah, that might be my choice.
Okay, what about excellent. You? Yeah, I'm debating that. So I currently have a Model 3 Performance, and I don't know if people have driven the Tesla Model 3. So there's a huge difference between the base model and the Performance, like just astronomical difference. I rented the Model 3 base model standard range last year, didn't like it. I thought, you know what, I'm never going to buy a Tesla, don't care. And then this year, I walked into a dealership. I was just like, I'm curious. Let me drive the long range just to test it out. Completely different car. They shouldn't even be in the same category. Like, it's just completely different. So, yeah, I have the Performance. I love it. It's a good daily driver. It's practical. It's really fast. Like, it's faster than a Lamborghini Huracan, 0 to 60. It's when you get from like 60 miles to like 100, like 120 miles. That's when other supercars start beating it. But 0 to 60, it's just super fast. So I like the Model 3. If I were to take one car, and I could drive anywhere around the world with it, maybe a Toyota Land Cruiser, because then I can go anywhere with it. But yeah.
Ooh, awesome. Well, great. We'll get driving once we both get our Teslas. I'll meet you in California.
All right.
Perfect.
Great chatting with you.
Awesome, buddy. Yeah, thanks for coming on.
All right. Take care.
Take care.